Welcome to the deep dive. Today, we're jumping into something really key for Canadian finances, the tax-free savings account, the TFSA.
Right. It's often talked about, but there's still, some confusion.
Exactly. So we want to cut through that, give you the essential info you need to really understand and use this thing. Think of it like a financial booster.
That's a good way to put it. We've boiled down the key rules and benefits for you.
Okay, great. So let's start simple. What is a TFSA, fundamentally? That tax-free part sounds, well, pretty good.
It really is the main draw. So basically, it's a registered account. You put money in, you invest it, and that investment growth, it's not taxed.
Not taxed at all. Like interest, dividends, capital gains, none of it.
None of it while it's in the plan. And then when you pull the money out, those withdrawals are tax-free too.
Wow, okay. Tax-free in, tax-free out. That's powerful. Who gets to open one? Any Canadian.
Pretty much any adult Canadian resident. You need to be 18 or older, living in Canada, and crucially, have a valid social insurance number, a CPA.
Got it. 18 plus, resident, valid, SIN. Okay, now, this contribution room idea. How does that work? Is there a limit?
Yes, absolutely. The government sets a limit each year.
Yeah.
For 2023, it was $6,500.
Okay, $6,500 for last year.
Right. And the really neat thing is, this room starts accumulating from the year you turn 18 or from 2009 when TFSA started, whichever is later, even if you never open an account or put a dollar in.
So it just builds up in the background like unused credit.
Exactly like that. It carries forward indefinitely. So you might have a lot more room available than just the annual limit if you haven't been contributing.
That's fantastic. What if I say, save up $5,000, put it in, but then next year I need it back for an emergency? If I take it out, is that contribution room gone forever?
Ah, good question. No, it's not gone forever. That's
Yeah.
a huge advantage of the TFSA. If you withdraw funds,
Yeah.
you actually get that contribution room added back.
But,
And this is important. It only comes back at the start of the next calendar year.
oh, okay, so not immediately. If I pull out $5,000 in, say, July 2024.
You'd see that $5,000 added back to your available room on January 1st, 2025, plus whatever the new annual limit is for 2025.
Right. So there's a delay, but you don't lose the room permanently. That offers a lot of flexibility.
What can I actually put inside a TFSA? Is it just like a savings account?
Oh, much more than that. Think of the TFSA as a container. Inside that container, you can hold all sorts of investments.
Like what?
Well, simple things like cash or GICs, those guaranteed investment certificates, but also mutual funds, stocks, bonds, basically a wide range of investment options.
So it can tailor to my goals,
Hmm.
maybe safer stuff if I need the money soon, or stocks for long-term growth.
Precisely. You can match the investment inside the TFSA to your timeline and risk tolerance. Short-term goals might lean towards safety. Longer term, you might accept more risk for potentially higher tax-free returns.
Makes sense. Okay, this sounds great, but are there any, traps, things I need to be careful about?
Definitely. The main one is over-contributing, putting in more than your available contribution room. Right, because the room accumulates, but it's still finite each year. What happens if I mess up and put in too much?
Uh-oh. Yeah, the government charges a penalty tax. It's 1% per month on the amount you've over-contributed.
1% per month? Ouch. That could add up really quickly.
It absolutely can. You really want to track your contributions and know your limit. There is a small buffer, technically.
Buffer?
Yeah, there's a rule that allows a $2,000 over-contribution without that penalty kicking in immediately, but it's not really meant to be used strategically.
Yeah.
It's more like a small margin for error. Best practice is just stay under your limit.
Okay, good to know about the buffer, but yeah, definitely aim to avoid it. What if I move away from Canada? Become a non-resident.
Right. If you become a non-resident, you can't contribute any more money to your TFSA. Your contribution room for that year gets prorated, and you don't accumulate new room while you're non-resident.
But what happens to the account itself? Do I have to close it?
No, you don't have to close it. The account can stay open, and the investments inside continue to grow tax-free, at least from Canada's perspective. Withdrawals also remain tax-free in Canada.
Okay. But my new country might tax it.
Potentially, yes. You need to check the tax laws in your new country of residence. But Canada won't tax the growth or withdrawals after you leave.
Important detail. Okay, another scenario. What about passing on a TFSA? What happens upon death?
If the TFSA holder passes away, the funds can generally go to beneficiaries tax-free. If the beneficiary is a surviving spouse or common law partner who's also a resident, they can essentially absorb the deceased's TFSA into their own, tax-free, without using up their own contribution route. It's a direct rollover.
Okay, that's useful for couples. What if the beneficiary isn't a spouse? like a child or a friend.
For other beneficiaries, they receive the value of the TFSA tax-free as of the date of death.
Hmm.
However, the money doesn't retain its TFSA status, and the contribution room isn't transferred. It just becomes regular cash or assets for them.
Got it. Tax-free payout, but the account itself doesn't continue as a TFSA for them. Now, quick comparison. TFSA versus RRSP. People always talk about these two. What's the key difference in simple terms?
The big difference is when you get the tax break.
Yeah.
With an RRSP, the Registered Retirement Savings Plan, your contributions are tax deductible. So you get a tax break now, reducing your taxable income in the year you contribute.
Okay. Tax break up front for RSP.
Right. But when you take the money out of the RSP, usually in retirement, those withdrawals are taxed as income.
Ah, and the TFSA.
It's the opposite. You contribute with money you've already paid tax on after-tax dollars, so no tax deduction up front. But as we said, the growth inside is tax-free, and the withdrawals are completely tax-free. No tax implications when you take it out.
So RRSP is tax break now, pay tax later. TFSA is no tax break now, but no tax later.
That's the core difference, yeah. Which one is better really depends on your current income versus what you expect your income and tax rate to be in retirement.
Right. Makes sense. It depends on your personal situation. Okay, so wrapping this up, the TFSA really offers some compelling benefits. That tax-free growth, tax-free withdrawals, and the flexibility to get your contribution room back later. Seems like a must-have for most Canadians.
I'd agree. It's a very valuable tool. But, understanding those contribution limits, the withdrawal rules, how it interacts with residency, that's key to using it effectively and avoiding those nasty penalties.
Definitely. So for everyone listening, hopefully this clears things up. Maybe check your own CRA My Account to see what your actual TFSA contribution room looks like. It might be more than you think.
Good point. And maybe think about this. Knowing that the growth and withdrawals are tax-free, how could that influence where you hold certain types of investments? Could the TFSA be the best place for investments you expect to grow the most? Something to consider for your overall financial strategy.